Hi, and welcome back. Today, let's dive into trade date accounting and settlement date accounting, two important methods for recognizing and derecognizing financial assets and liabilities. Let's start with trade date accounting. The trade date is when an entity commits to buying or selling an asset. Under trade date accounting, the entity recognizes the asset to be received and the liability to pay for it on the trade date. Similarly, if the entity sells an asset, it derecognizes the asset, records any gain or loss, and recognizes a receivable from the buyer, all on the trade date. Here's something to note. Interest usually doesn't start accruing on the asset or liability until the settlement date when ownership officially transfers. Now, what about settlement date accounting? The settlement date is when the asset is physically delivered to or by the entity. Under settlement date accounting, the asset is recognized only on the day it is received. Conversely, when the asset is delivered, it is derecognized and any gain or loss is recognized on that same day. What happens during the gap between the trade date and the settlement date? If there are changes in the asset's fair value during this period, for assets measured at amortized cost, no changes in value are recognized. For assets classified as fair value through profit or loss, FVTPL, changes in value are recognized in profit or loss. For assets measured at fair value through other comprehensive income, FVOCI, changes in value are recognized in other comprehensive income. Thanks for tuning in, and I'll see you in the next session.